Hello, and welcome to our latest economic and industry update brought to you by Greenbrier's marketing team. I'm Mallory Moran, and I'm joined by Jay Carter. I'd like to begin today with some broad economic metrics. For those of you that don't know, gross domestic product, or GDP, measures the amount of goods and services produced. So Jay, tell us about the U.S. GDP forecast for this year.
Well, thanks, Mallory, and I'm excited to be here with you as we kick off 2022. The U.S. GDP for 2021 grew at about 5.7% versus being down 3.4% in 2020, and is forecasted to grow at about 4% this year. Now, unemployment concluded 2021 at 3.9%, which is an improvement from the 4.7% at the start of the fourth quarter of 2021. And unemployment is projected to end 2022 at about 3.7%.
Now, the high rate of inflation has been making a lot of headlines lately. Should we anticipate inflation will continue to increase?
A little, particularly in the short term. The current interest rate and supply chain issues are large contributors. Inflation forecasts have been raised to 4.8% and 2.6% in 2022 and 2023, which reflects inflation softening towards the second half of this year and into 2023. Now, we still expect the Fed to raise the federal funds rate by 25 basis points in March of this year, with additional increases into 2023. Ultimately, this will help to combat inflation.
Thanks, Jay. Now let's talk a little bit about the freight rail industry specifically. It's good to note that railcar orders and deliveries are very cyclical, lots of troughs and peaks. In fact, 2021 was a trough year. Now, the industry reported final 21 railcar orders, deliveries, and backlogs last week. The numbers are huge. Orders increased nearly 300% year over year to over 13,000 railcars, which is a 57% sequential increase from Q3. In fact, this is the highest quarterly order increase since Q4 2018. Now, over 8,000 railcars were delivered in Q4, and the backlog rose for the third straight quarter, up 15%, to nearly 43,000 units. So Jay, tell me what is driving this big demand.
The North American fleet utilization through January was about 81%, with roughly 2,000 rail cars being pulled from storage. Now, there are over 31,000 sand cars and over 46,000 tank cars in long-term storage, which indicates that they have not moved in over 1 year. Now, if you exclude these cars, there are roughly 236,000 rail cars in storage. Also, in January, there were approximately 4,200 rail cars that were scrapped, which is in line with recent trends.
Rail loading volumes probably offer the biggest impact to storage and utilization. While 2021 rail volumes were up about 4.6% year over year, overall volumes are still down compared to pre-pandemic levels. So Jay, what are some of the changes in volumes that we're seeing?
Last year, we saw a softening in grain, intermodal, and auto volumes, particularly towards the end of last year. We also saw many railroads govern intermodal traffic to maintain their network fluidities. Further, supply chain shortages have hampered auto manufacturing. Later this year, as WTI, or West Texas Intermediate, which is a global oil benchmark, as it reaches its forecasted peak of $125 per barrel, we'll start to see an increase in Canadian crude by rail, which will further support rail loadings. We also expect auto loadings to provide some support for industry rail loadings at some point in 2022 or 2023.
That makes sense. So overall, it seems there continues to be significant pressures on commodities and supply chains, impacting areas across the broader economy, as well as the rail industry specifically. Any final thoughts, Jay?
Yes, just two last comments. When global supply chains improve, we should see inflation start to cool off a little bit. In this situation, steel prices will also continue to fall from their 2021 peak. Also, we will see rail cars in storage bottom and possibly increase slightly as rail networks improve their fluidity.
Thanks, Jay. And thank you for joining us. We hope you'll find this video valuable. Be sure to check out next quarter's edition.